Welcome to this LinkedIn live event hosted by Marvin Labs. NVIDIA just delivered 57 billion in revenue and 31.9 billion in net income in a single quarter. Data center revenue now accounts for 90% of its business. These results pose interesting questions about how investors view AI infrastructure. Paired with record capex from hyperscalers, the question is no longer if AI is real, but whether the economies of scale are sustainable. In this discussion with Alex and Max, we'll break down how AI's infrastructure cycle compares to prior tech booms, whether earnings are catching up with valuations, where investors are speculating durable value from thematic positioning, and what the next phase of monetization could look like. We have several charts throughout, and as always, please feel free to ask questions in the comments box. But first, let me introduce today's speakers and panel guests, Alex and Max. Alex, I'd like you to introduce yourself first, together with Marvin Labs, and then I'll come to you, Max.
Yeah, hi, I'm Alex. I'm the CEO and founder of Marvin Labs. I am an investment banker by training. I spent some time investing and in and around startups. And as of about 18 months ago, I founded Marvin Labs. And with Marvin Labs, we are helping professional investors with an AI co-pilot and AI agents do better research and find better investment ideas.
That's great. And Max, do you like to introduce yourself?
Yeah, sure. Hi, everyone. My name is Max. I am a co-founder and portfolio manager at Israel Financial. We are a registered investment advisor in California, but my background is actually, I've been in the wealth management industry in London since 2016. And most of my focus previously has been on equity research on the buy side. And now I'm responsible for the investment management side of our current business.
That's great. Thanks, Max, and thanks, Alex and myself. I'm James Yerkes, a former global managing director in HSBC. So let's come to the first question to discuss. Obviously, the backdrop of NVIDIA's results today, which are pretty stonking. Capex across hyperscalers has sort of reached record levels now, but is AI infrastructure spending sustainable long term? And that's a really interesting question. And I'm going to come to you first, Max, to open that one up for us in this discussion.
Okay, I would say it is sustainable structurally, but quite scary cyclically. If you look at these numbers, they just look insane, right? And I've seen estimates from Goldman Sachs. I believe they put the overall number between 2025 and 2027 at around 1.5 trillion. But actually, if we compare it to, let's say, .com bubble, right now, I believe overall capex by big tech is around 1% of GDP, whereas previous bubbles topped at between 2 and 5% of the overall GDP. And also another important distinction is the current cycle isn't over leveraged. Most of it comes from the actual earnings and cash flows of those big players. So I would say there is froth in the market, and it's a question of the long-term demand assumptions that are implied in those investments. But I don't think it's a dangerous bubble, to put it this way.
Mm-hmm. Alex, what are your thoughts on that one? Just as an opening thought on this topic about AI infrastructure spending and sustainability long term.
Yeah, I think the crux of the whole matter is less. And I kind of share Max's sentiment here. It's less about like, can we actually finance this? Can we fund this? Because per Max's point, right, a lot of that comes from the balance sheet comes actually from the cash flow, not just from the balance sheet of hyperscalers. A lot of that will eventually come from debt financing of hyperscalers or some structures, which is kind of really within the realm of more than in the realm of feasible and of historical precedent. So don't worry about kind of financeability, as some kind of, I think, start to do. I think the bigger question is will there be a sufficient ROI from these? I think the fascinating things about kind of this discussion is a little bit of like people just assume like we're committing now to 1.5 trillion capex annually for the foreseeable future, without kind of having any path dependency and without having any visibility on the ROI of this. And I think when we think back through some prior investment exuberance, we had longer investment cycles, right? If you think about the dot-com bubble and putting fiber into the ground, that is a considerable investment, and that has a considerable return period. Like obviously data centers have that, but a lot of the capex here a lot of the capex decisions at least are not immediately reversible, but we're not committing to a 10, 15, 20-year investment project, by and large at least, and we can't kind of turn off the spigot in a year's time or in 2 years' time when we discover that our return assumptions are not met.
I mean, Max, what do you think of capex as a percentage of GDP? I know you've got some charts that you might have on that, but what do you think of that? Because capex is almost in some ways it's a macroeconomic force in some ways.
Yeah, I do actually have a chart on slide 6, if we could share it on the screen. Yeah, so these charts from TS Lombard show an interesting picture. So on the right, you can see comparison to .com, and like AI has just kind of like recently started, right? Just a couple of years. But another interesting metric is during the .com bubble, the overall capex was growing by 20% every year for, I think it was around 5 years. So far, we adjusted from this perspective, we're still at the beginning of the cycle. So I don't think it's a big problem yet. And again, as most of this capex is funded from the cash flows of these big tech players, it's not as dangerous yet. But we do need to keep an eye on private credit space. If more of those funding vehicles are involved, and if companies use more of the special purpose vehicles off the balance sheet financing, then it might become a bigger problem.
Yeah, I think that's a good point. Actually, for me, that's one of the questions about the funding mix between internal cash and debt markets, along with obviously the ROI thresholds. It will determine whether the spend, remains defensible, I guess, in the medium term. It's that mix piece. I think JP Morgan recently commented that AI infrastructure is a foundational layer, not a discretionary cycle, which I thought was a very powerful point. And when you look at your comparative charts here, I think that one comes through. Alex, what's your take on these charts and the sort of historical context?
Yeah, I think if we extrapolate the charts, right? I mean, just looking at, even if we don't do the 2030 numbers of AI capex that some people are touting, even if you look at just a year or two ahead, right? We're talking about growing from 1% of GDP to 1.5%. So we're still within historic context, and I think it's easy to get lost in this. This is almost $1 trillion that we're probably spending in 2 years, and by the end of the decade, we're spending way more than $1 trillion. It's just a massively large number, and this seems so basic, but we didn't spend this fantastically large number in .com just because we're 25 years later and we have inflation, and the number is now fantastically bigger just because of inflation. And I think this 1 trillion number is truly scary, right? It sounds incredibly scary, but when you kind of put it in context of GDP, right, it's no longer that scary. I think if we spend 2% of GDP, right, global GDP is what, 80 trillion. So 2% of GDP is 1.6, 1.8 trillion. And that's not that all of a sudden doesn't sound too scary anymore.
No, it sort of doesn't. The one thing that struck me about NVIDIA today was I think their Q3 profit was bigger than the entire US energy sector for the quarter, and that again, we're going to have more comparisons like that, I think, going forwards, because these numbers are so huge in terms of, you're into the trillions now, which is substantial. I guess that leads more to a sort of topical question based on earnings and what we're seeing currently, which is where is AI already improving our margins? We're talking about all the capex investment and the trillions being plowed in, but are we seeing anything coming through already about improved margins? Obviously, NVIDIA being an interesting example today. Max, what's your thought on how the current landscape is looking regarding early signs of improved margin, improved profitability?
You mentioned the infrastructure layer by JP Morgan. I think it's a useful lens to use. And on the infrastructure layer, we definitely see this profitability. Again, NVIDIA is a great example, and other big cloud providers. But going further down the value chains, application layer, and I don't know, like end users, this is where I guess it's more questionable, and I guess we'll just need to wait and see. But again, so far, more disclosure by companies like Microsoft on specific AI demand. I think it's a good sign.
Yeah, Alex, what's your take on that?
Yeah, I think there's kind of two perspectives to that. One is like we're clearly seeing OpenAI is rumored to be at a 20 billion a year clip, revenue wise. That's like clearly people are spending this amount of money not just to burn it, but there is some economic outcome that is at least sensible. So I think people and OpenAI does this with like what 200 million, 300 million monthly average users, monthly active users. So like they're doing this on a large enough scale that it's kind of fair to conclude that like somebody is reaping at least 20 billion of return from their spend on OpenAI. So I think that's positive. And I think the same goes for a lot of other AI vendors, a lot of other foundational models. Right? Anthropic is probably not that far behind. Google doesn't disclose AI income, but I mean clearly they must be able to generate some of it. Same for Amazon. I think that's one where people use foundational models or tools like Marvin apps or something for their industry to find sensible business outcome. I think the other thing is if you then look at like Meta is always reporting how much their ad customers are benefiting from AI. I think that's kind of these AI use cases that don't look like chat, which is kind of another thing. And then if you look around the ecosystem, right, you find these things everywhere, right? You find them with an Adobe, you find them with an Amazon, you find them with Google, who often touts these numbers. And I think that's the other big case where people reap rewards from AI that don't look like we are now associating AI, right? They don't look like a chatbot.
No, I think it's interesting. I mean, I think NVIDIA, I know I keep mentioning it because of its results today, but when you look at its free cash flow, I think it was at 22 billion, and you look at, gross margins up 73%, there is monetization taking place, albeit there's lots of factors in that. And I think, Meta, Adobe and Google Cloud are seeing early margin expansion from AI-driven products. So there's definitely, ad optimization, I think, is another one that I hear a lot of people talking around, in terms of optimizing ads through AI. You can see it on LinkedIn, you can see it on Facebook, you can see it on Instagram, where there's a lot of money going into optimizing paid ad services and things. So I can see that coming. I think, I guess the question for me is again, how you match up the scale of investment with the speed of, I guess, improved margins, improved productivity, how the two align or don't align over time. I think, Max, I know you might have some thoughts around the US tech EPS versus price, because I know there was potentially some data on that you might want to share around price gains being backed by real earnings.
Right. So if you could shared slide number 12.
I thought that was a good one to just come to here around price movements.
Yeah, so this is a chart from Goldman Sachs where they show the price performance of US tech and change in the expected earnings. I mean, you can clearly see the correlation here. And again, tying this back to my first initial comment that even if this is a bubble, it's not driven just by hopes. It's actually driven by actual earnings. And I do have another set of charts, I believe, on the next slide. If you could pull it up. Again, charts by Goldman Sachs. From the chart on the left shows the valuation, where it compares US to other markets. And yes, US is expensive. However, if you look in the middle, it's also very profitable at the same time. And again, the chart on the right compares valuation, so price to book and return on equity. And you can see, even though the valuation currently is high, it is justified by actual profits, even if it is concentrated in the top 10 companies of the S&P, which actually brings another risk of concentration. But still, if you look, if you compare valuations against profitability, it kind of looks justified to me.
Alex, what's your thoughts on this chart? These charts, the previous one and this one.
Yeah, I think it's I think I can only echo Max's points, right? I mean, it's very obviously you will always find examples of insane valuations, right? I mean, like I'm sure somebody will cite Palantir, somebody will cite Tesla, of valuations that let's be cautious here, that look aggressive. Maybe that's a term that is not offensive. But then if you look at other stuff, right? I mean, if you look at a Microsoft, at an Amazon, at an Apple, right? I mean, and that is massive concentration of S&P and of their world. They don't look insane, and they are growing. I think it's sometimes very difficult to just get a sense for the scale of the hyperscalers. I think it's sometimes easy to lose track of that, how big they are, right? I mean, we're talking about what, 700-800 billion of EBITDA that the hyperscalers make, similar levels of free cash flow. That is massive in terms of scale.
Yeah.
And that probably leaves half a trillion of earnings. I mean, slightly less, but still, it's a massive scale that these companies have, and it's massive economic impact. And it's kind of sometimes easy to lose track of it when you're kind of debating whether OpenAI has a sensible valuation or not, or whether Palantir has a sensible valuation or not.
It's interesting because there's a question in from Jacob, which is why is NVIDIA's data center business growing faster than its gaming? And it plays a little bit to that point. I mean, the data center demand has exploded, hasn't it, due to sort of AI, and I think it's now 90% of around that figure of NVIDIA's revenue. Max, what's your thoughts on that question? Why is the data center business growing faster than gaming?
Well, simply because the demand from this hyperscalers and cloud providers is just much, much larger. And for the NVIDIA chips themselves are more advanced for data centers and higher margin products as well, if I remember correctly. And gaming industry isn't just, I think the overall gaming market is 200 billion, something like that.
We talked about it last month.
We did it last month on one of these. Yeah, and we're covering it next month. For those of you watching, we're doing the gaming industry next month as well. So stay tuned for that one.
Yeah, so essentially, the gaming industry isn't just as big compared to data centers.
Yeah, and then also, I mean, you take a look at the different generations of chips. I mean, Blackwell is NVIDIA's newest architecture, isn't it? And that seems to be pushing out H20, not H2O. I used to get that one wrong myself. Alex, what's your thoughts on data centers growing faster than gaming? Is it pretty much what Max said, or anything else you want to add to that, to Jacob's point?
Yeah, I mean, we're looking at what, like a 20-25% expected growth of data centers over the next half decade or so. I think we're looking to add around 100 gigawatts of data center capacity to the market. And I think there is about 120, 130 outstanding, so kind of almost doubling the market. And I mean, still, most of this is powered by NVIDIA chips. I'm quite surprised that it still is, to be honest, that we're still effectively having 95% of, well, I don't want to be kind of held accountable to this number, but we still have an overwhelming majority of data center chips being NVIDIA chips. I would have thought, if you asked me a year ago, that we are seeing some serious competitors entering the market, at least for some applications, at least for inference applications, for example, where you might imagine that you can do some trickery and produce a comparable performance chip. But I'm surprised that this hasn't happened. Please, Max.
No, I just wanted to add that I think it's a testament to the wide moat of NVIDIA's business model.
Yeah.
Again, the technology that they've been building for decades, essentially, right? And it's not just hardware; it's like the software layer as well. But I think, AMD is slowly catching up. But actually, on that front, Google released the Gemini 3 just a couple of days ago, and if I'm not mistaken, this is the first model that was trained entirely on the Tensor chip units.
Yeah.
Which might indicate, going forward, there may be alternatives.
Yeah, I think there actually, one thing that I find interesting, right? Because I think a year ago, 2 years ago, we would have all said, right? I mean, the moat from NVIDIA comes on the hardware and software side, and I think a year ago I would have agreed to your point, Matt. I think. I mean, we're now at a point where we're spending $500 billion on AI infrastructure, and a lot of that is spent on compute, right? And you'd imagine, like, the software, if the software mode is, and I think a year ago people would have said, right, the mode is mostly convenience. The software mode that NVIDIA has is convenience because everybody can use CUDA infrastructure. It's ingrained in all the models. It's ingrained in all the training pipeline. But we're spending so much money now that if this was just convenience, if this was just this is the best tool that is out there, but we could probably, if there's other hardware, we could write another tool, and it might be slightly annoying migrating stuff, right? I think one of the cloud providers estimated that moving from CUDA to a different model takes 3 months. So it's surprising that, because you'd imagine at a 500 billion spending clip, right, you'd overcome this is just a convenient software layer as a moat. And it is, I think, an even starker testament to NVIDIA's hardware moat to say, right, we're at a stage, we're at a spending level where every software mode is probably overcomable. So the hardware mode must be staggering for anyone that isn't Google.
It was interesting, Alex. I'm going to sort of half whimsically come back at you on a point you said to me. You said you didn't want to be held accountable for a number, which is a nice segue into AI, our AI guidance statements becoming more credible, obviously increasing references to monetization and timeline. So what are your thoughts on that, Alex, around investors becoming increasingly skeptical of vague or qualitative AI ambitions and credible statements, half whimsically to your point about you didn't want to be held accountable for a number?
So I think it's fast. I think it's very interesting to see, like, every hyperscaler talks about next year's capex guidance. They give this year and next year's capex guidance. I don't think anybody gives a T+2 capex guidance. And I think that is incredibly sensible. And I think there has now become a cottage industry of consultants, sales, sell-side research that are trying to kind of look at 2030, 2035 numbers, and kind of extrapolate a little the commitments. I think it's potentially tricky to do that because we don't have that much data on the ROI of all of these investment projects. And you'd imagine like a sensible organization, a hyperscaler, looking in 2 years' time at their data center ROI of 2025, 2026 vintages that are starting to come in, because it's not that crazy long of an investment project, and kind of reevaluating what they want to do 2028, 2029, 2020, 2030, depending on that. So it's like a lot of this data is highly path dependent, right? We're not going to spend 1.4, 1.5, 1.7, 2 trillion in 2030 if we're discovering that all of these investments in data centers in 2026 to 2029 are incinerating money. So I think it's very sensible that people are just having a shorter outlook, because all of this is like, it's still a fairly, in terms of investment projects, in terms of capex, it is like fairly visible, and it is a fairly quick return period where you can at least see kind of some of the returns, right? I'm not saying that a data center amortizes in 2 years or 3 years, right? But I'm saying, right, you'll get some sense for the ROI that you can expect out of a data center in 2-3 years. And if this is just burning cash, then you won't spend at the same level as you're kind of doing now.
No, I think I agree with you. I mean, I've seen Microsoft, Alphabet, and others, Salesforce in particular is one that they've added quantifiable AI revenue and KPI disclosures, which is quite interesting. But I mean, I do have some sympathy here for some of the numbers and some of the forecasts. I mean, I've been in a very large multinational bank, global, and when you're trying to gaze ahead with even tens of millions or even hundreds of millions of spend, trying to predict what the business case or ROI would be on it, that's hard enough, let alone when you're getting up to these levels of investment. It's almost, I would say it's almost extremely difficult, if not impossible, to even put a business case that's robust enough around some of this. You've got to be pretty good at doing that, given my experience with spending tens or hundreds of millions has been difficult enough to predict.
I mean, Meta has greenlit I think like a 25 gigawatts. No, it's too much. I think it's a 30 billion investment, so it's like a 5-6 gigawatt data center recently that they externally funded. And I think the payback period on that is like 20 years, right? It's a 20-year project. But I think it's important to realize that a solid 50-60% of the spend on that data center is going into concrete, it's going into piping, it's going into a power plant, it's going into like non-fancy things. Like, it's not going to NVIDIA, into cutting edge chips. Like, that is 20, 30, 40% that is going there over some time period. And, these chips over the 20, 30-year lifespan of that data center, or over the 20, 30-year payback period of the data center, they need to be renewed. So I think it's like, there's also no assumption that this is just a 2030 and you leave it and that's it, like you would with fiber in the ground. So I think it's like it's these projects are quite dynamic, right? It's not you sink a lot of money up front and there's no alternate use, and it's all like if the ROI isn't there, it's all going up in flames. I think there is a lot of path dependency in all of the spend, and I think that's I think that's the reason why people can commit to spend 500 billion across all hyperscalers next year, because they know they're not committed to doing the same the year after. If this turns out to be a bad investment.
Yeah, I think that's a very good point, Max. I just want to build on that with the theme around valuations and what's driving valuations. The balance between just pure speculation or backed by substance. What's your thoughts about what's driving some of the valuations at the moment? Given the sort of valuations are very different across some of the AI companies that we know.
Overall, I would say the valuations are stretched to varying degrees in different corners of the market, but I don't think it's overly extreme. And again, if I can compare it back to the dot-com bubble, I think the top 7 tech stocks back then traded at around 52 XP. Today, the Magnificent 7 is around 27, something like this, mid-20s. And then again, I do have another chart from Goldman Sachs on slide number 7.
I'll just go to that
where
one.
Again, they do the breakdown of performance driven by the expansion in P and expansion in earnings, and the highest bar charts. You can see the second one is actually US tech. The first one is European TMT stocks, and you can see the dark blue portion is the expansion in the multiple, right? So expectations. The light blue is expansion in earnings contribution, and if you compare it to today, I mean, it's not as extreme, first of all, and then also majority of it is driven by earnings. So I understand the worry around valuations, but I don't think it entered like the extreme levels or too overstretched.
What do you think, Alex, about overstretched, and also that tie back, as you've pointed out here on the slide, is different to the dot-com peak?
Yeah, I think this it's completely fair to. I think it's fair to have the initial thought of having a comparison to the dot-com peak because it's technology and it's like some of what's happening looks, if you squint, fairly similar. I also think like a lot of people in the market nowadays, like including myself and I presume Max as well, haven't lived through the dot-com era as investors. So I think it's always kind of a lot of it is anecdotal knowledge in how it felt, how markets were, how crazy things were. I think that's always slightly difficult from just a evaluation standpoint because you're evaluating something that you haven't lived through. And it is because it's the crash 2 crashes ago, right? It's like it's still in our brain. But I'm surprised nobody kind of is citing a railroad crash in like 1912, which I assume was there, to compare this to. But it's just because it's very present still in I think in everybody's mind. I think similar people are thinking just because the financing becomes large numbers, people compare it to the housing boom in 2007-8. And I think that's the even less apropos comparison. I think this is Dostoevsky quote, right? That all bad families are bad for different reasons. And I think all crises are crises for different reasons.
Gosh,
if we end up in a crisis.
We don't also get Dostoevsky, and that's a difficult one to say on our LinkedIn lives. But well done there, Alex. I think I'd add as well, having been old enough to live through the dot-com bubble, only just in my 20s, I should add for the audience. It did feel very different to me. Having gone through that first one, it's more at that time it felt more like the crypto kind of bubble that we have now, and the fervor around that. Whereas I think what's interesting is, in terms of the AI capex, it's almost like I feel like the .com bubble is more associated with the crypto rise at the moment than it is actually with the AI capex piece in terms of pattern. But that's just my personal view, having gone through that kind of .com bubble. I mean, I guess, Alex, the question to you really about, are traditional valuation models struggling to keep up with some of the changes in terms of, the AI exposure within a business, or, are they still sort of fit for purpose given firms are burning billions in capex before any earnings actually gets returned?
No, I think that's completely fine, right? I mean, we're using models that our great grandfathers used to value railroads, and like they lived through. I think there's always a discussion when new technology comes around if valuation models still make sense, but by and far, right, they are robust. They work there, and plus, I mean, they are tools anyways, right? It's not like they tell us some innate truth about what something should be worth. That's just what the market does. They just, are guiding sticks, helping us, and I'm sure there's some evolution, but I mean, in the end, it's still a comparison of how much cash goes out, how much cash comes back in eventually, and how much you're willing to pay for that. I don't think that changes. I think I would be more worried if we're talking about kind of introducing some of the Bitcoin valuation models that people have discussed 3-4 years ago into the space, but I don't think anybody's kind of seriously doing that. I hope at least not.
No, I hope so too. Especially given the last couple of weeks in some of the cryptocurrency space. Max, what's your thinking around this? And I think you might have a chart as well on revenue per watt and capex dollar metrics we might want to share as well.
Sorry, let me just quickly. So I don't remember the chart that we just mentioned, but overall, my thoughts are, again, if you look at the tech sectors, so actually price to earnings to growth ratio, again, is not so extreme. It's around 1.7. Again, during the .com bubble was around 3.7. And at least we are still using like traditional metrics, whereas I remember I was reading during the .com bubble, investors were coming up with new type of metrics when they compared financial KPIs to like users or some other like non-traditional KPIs that would indicate like future revenue and future earnings. And when this type of like alternative metrics come up, I think is an indicator that we are entering in like a dangerous territory. So far, like I don't see that, at least not too often. And overall, if you think about if AI is a bubble, at least people are worried about this fact, and we are not in a euphoria stage, right? When people just believe, okay, it's gonna go up forever. So at least that gives me, like from a contrarian perspective, I'm a bit more comfortable.
Yeah, I think to Max's point, right? I mean, it's very encouraging. Like all of our discussion so far today, and all the serious discussion is about like, is there an ROI on these investment projects, and not is there a societal benefit? Are we generating users? Are we like? I know some of the hyperscalers report how much usage they are seeing, and token counts and stuff like that. But I don't think anybody uses that as a valuation metric. So I think we're still seeing predominantly people talk about some revenue, cash flow, EBITDA, earnings numbers, by and far. Nobody's doing user counts. Nobody is doing community adjusted EBITDA. As some startups have done. It's revenue, and that is the metric. And I think that is very positive, right? We're not divorcing ourselves from the reality that all of this needs to generate some amount of revenue and cash flow.
I think just off the back of all the sort of scale and that, there's a question in from Oliver Oh, nice to see you, Oliver Rothschild. Do discuss the amount of energy resources needed and the preferential treatment that is and will be needed to ensure 100% working activity and responsiveness. So energy isn't something we've talked about, but certainly the JP Morgan report that came out recently, highlights the sheer scale of the energy consumption needed to support the scale of growth, whether it be finance or the actual, infrastructure development itself. What's your thoughts on that, Max and Alex, the whole energy play here?
Yeah, I do agree that we need to pay attention. But personally, I haven't done deep research on that front. All of my knowledge is just anecdotal and from some bits and pieces here and there, asking questions if the grid can sustain this demand, and again, if there's just enough electricity around to run all of these GPUs. But again, I don't have anything of value to add at this moment.
Alex,
I think this is predominantly a political discussion, right? I mean, it's a societal political discussion of whether we want to commit energy to this, and how do we want to do this, what kind of energy that is, and I'm sure societies have some view on that. I think all we are here to do is to say, right, can we power this economically sensibly? Not societally, not politically, not environmentally sensibly, but can we do this economically sensibly? And what does it need to get this done? And I think that's where every investor's responsibility is that, and where politicians, societies need to figure out if this is sensible.
Yeah. I mean, I think there's a couple of points for me. I think the sort of energy is now, I would say, a strategic differentiator, and the cost and source of energy is impacting people's ability to profitably scale AI, or will continue to be a key piece. And I think some of the cloud providers I see are kind of racing to secure, sort of green power as well, because there's also the environmental concern, I guess, behind this as well, that, AI can account for, I think it's somewhere around about 5% of global electricity demand by 2030, if current trends continue. That's quite sizable. The other bit, I think, is it's interesting to look at people like NVIDIA themselves, that whilst they don't run the data centers, directly, the GPU efficiency improvements and better performance coming through those should help reduce energy intensity over time. It's, for me, the question, though, is whether or not the improvements in infrastructure that are lowering consumption of energy through chip design are actually offsetting the sheer scale of power needed to power the whole infrastructure itself. But that's a good question, Oliver, and thank you for that one. And Jacob, you've asked a question. It sort of ties back to our earlier points, but maybe worth just swinging back in case anyone, Alex or Max, have any other thoughts on it, which is how can we tell if companies are actually making money from the AI systems and not just spending money on them? Well, I guess it's quite a fundamental question, that. Any thoughts on both of you on that one, just before we move on?
It's probably the most important question right now in the minds of investors. And again, I probably still wait and see. But I do see that the patience of investors is kind of dwindling down. They do want to see more, not just qualitative statements, but actual numbers justifying these investments. And I mean, beyond NVIDIA. So again, companies like Microsoft, when they, I believe they said it was around 15 to 20% of Azure growth comes from AI demand. And James, you mentioned previously Salesforce. I forgot to mention that IBM, it's not on the revenue side, but they did mention they are saving around $3.5 billion via automation. So those specific numbers do help. And I do hope that more and more companies will disclose the actual figures going forward. But again, from your example, again, James, you mentioned it's quite difficult to pinpoint the actual ROI while we're still investing, right? So I guess we'll probably just need to be a little bit more patient overall.
Yeah. Alex, any thoughts?
Yeah, I share Max's view, right? I mean, we've been doing this kind of seriously for 2 years. Like this meat being kind of AI, modern day LLM based AI in the public or public consumption. We haven't been doing this for a long time, right? And it's like we're hearing revenue numbers coming from the model providers. We are hearing revenue numbers from some of the application layer. We're hearing the revenue numbers from the cloud provider, and I think it's all coming together that this is not just a single usage pattern. I think that would be a consider, right? If all of this is just people being curious on ChatGPT, trying to get a better recipe for their dinner, I think that would be kind of a slightly worrisome. But we're seeing kind of a vast array of old and new companies using AI for all kinds of different things. Obviously, some of them will tell you they use AI, but don't. But by and far, let's believe that when they say they use AI, they should do. They're using it in all kinds of different scenarios and all kinds of different purposes, and like all of these are sensible companies, right? I mean, like from a Microsoft to committing a lot of money, expecting to make a return, all the way down to like a Salesforce or a small, medium enterprise that is putting some AI chatbot into their customer service function. They are all doing this independently with an intent to save cost or make more money.
Which sort of ties me into a sort of question about research, AI and research. Before I do that, I sort of quite whimsically come back to your point about researching dinners. I've tried that on ChatGPT, and I find it incredibly sycophantic because you go kind of like, suggest something for my dinner, and then you go, I don't like it, and it goes, great, here's another thing. It's great you don't like that. What about this? I don't like that either. It's great you don't like that. Why don't you try this? It never actually says, I don't have any meals for you. I have actually tried that to get a meal plan, believe it or not, out of AI. I know it's slightly whimsical, but to just come back to the AI and research costs, I saw recently that Morgan Stanley had said Gen AI had reduced its analyst workload on meeting notes by 50%. Let's just swing into that in terms of beyond infrastructure spend and monetization. I see a lot of firms looking to deploy AI internally across sort of research, operations, compliance, those areas that are not necessarily linked purely to infrastructure. And I guess the question here is, are productivity gains material enough in those areas, to offset perhaps some of the, incredible costs that's going on infrastructure? Just wondered what your thoughts were on that in terms of some of the where AI is reducing research costs. Alex, do you want to, or Max, which one of you would like to have a thought on that one?
Max, you want to take it first up?
Sure. Yeah, I would like to demonstrate a chart from a recent Bank of America fund manager survey. If you could share slide number 3. Majority of those investors asked actually believe that the productivity gains are already here. They are happening. I don't have any more data to support this on a macro level or even by industry, but from personal experience, yes, it's the tool is definitely useful. But I still think investors and customers and society in general is still figuring out the application use or the different use cases for this model. We're still in this exploratory phase, I would say. And just to explain the chart on the right, this is interestingly the first time that the majority of global fund managers believe that companies are actually over-investing, at least since 2005. But yeah,
That's
those
really
are just my 2 cents on the topic.
Yeah, that's really interesting, that chart. I've not seen that before. And when I saw that, I thought, oh, that really is one of those outlier charts, isn't it? That, that really does stand out, doesn't it?
I think I mean, I think the reason for this is just it's so easy to point at 100 billion capex promises by 5 large companies and just be swayed to say, right, this is insane. I genuinely think this is the big reason for it, because it's so easy to come to the conclusion that like some of that spend is insane. But I think, James, to your question, and I think Max opened up with a kind of an interesting point, right? We're at the very beginning still of you know what AI can do, and I think both on a top down but also on a bottom up level, we're kind of seeing lots of people just experimenting with how they can use AI in their organization for their workflows, either to be more efficient or to open up new sources of revenue. And I think it's incredibly refreshing to see people do that. I think it's you know, just from personal experience, and hopefully Max and James, you can kind of share that as well, right? I think it's incredibly cool to see what you can do, how much you can amplify your productivity with AI tools. I think that's I'm sure what people felt when they first started using the internet. And I think that is incredibly cool. We're still kind of doing the early learning stages, right? We're not doing the scary stuff yet with AI. We're just doing the very, very low hanging fruit. And I think it's important to realize that this is not an IT project where, you know, we are now doing only the very hard IT projects because we have done all the easy ones. This is still the easy stuff that we're doing, and I think that's very encouraging.
I think that's a very good point about remembering the arrival of the internet. Again, I'm old enough and fortunate enough to have remembered the start of that. It's something that at the time we called the World Wide Web. So which is now moved on in terms of phraseology. But when you think about how far things have advanced over a 30 to 40 year period with that, compared to, as you pointed out a minute ago, this is year 3. If you go back and look at year 3 of what would have been then the World Wide Web, compared to now, it's incomprehensible where AI might be over that same time period rather than just a 3-year period. I think the other bit for me, back to the research piece, and you mentioned everyone will have their own kind of use cases. I think there's 2 things for me, and I'm sure it's the same for many people on here who have an interest in analyzing earnings, investments, etc. Is that it falls into 2 camps where AI is able to condense vast amounts of unstructured information and summarize it within seconds, sometimes even structured information. That huge sort of concertina crunching of information is definitely a use case that I certainly myself have benefited from an AI perspective, the ability to crunch enormous amounts of information and summarize it very quickly. And the second bit, which I think is a growing trend, and I know the Marvin Labs AI chat is a great example of this, is moving from the ability to just summarize or comprehend information incredibly fast, vast amounts of it, but to actually then interrogate it with questions in a Q&A sense. I think that's where I see changes coming in people's behaviors, that it's not just provide me a condensed piece of information, provide me that information, and then I want to question it. I want to have a question in it, and having an AI chat tool that allows us to do that. And you see the arrival of that even in some of the tools that Meta are launching and others, where it's moving beyond just the information to AI chat. And I know Marvin Labs, Alex, you might want to talk about that feature just launching, but that's a big feature, isn't it? When people are able to go and look at earnings releases and actually ask AI chat and have it as almost like a co-worker, as it were, in terms of being able to talk to somebody.
Yeah, and we only discovered it because people told us they use it like that. And because I think when you come from a design point of view, you start at you really start at saying, right, I mean, yeah, it's a good information compressor. And then you hear people using it, and they tell you, right? I mean, I use this to, make sure that my investment view is backed by facts, and I make sure that when I look at my investment view in 3 months' time, the reality hasn't drifted away from it. And I think that's incredibly interesting to see, and I think that's an incredible testament to us being in the very early stages, and people just experimented with it and kind of finding new things. And I was talking earlier to somebody about kind of how they approach AI in the organization, and I think the big insight to me on these questions is always if you run an organization and you want AI to work in your organization, it's you need to get out of the way. You need to give your people some amount of time, budget to actually start experimenting, right? Give them tools, give them time to use the tools, give them a forum to share what works, what doesn't, and that's it, right? And otherwise, just get out of the way. You don't want AI to work like an IT project where you have a 3-month review on what you're doing, then force it with Big Four consultant through an organization. The project being dominated by risks rather than by rewards. It all being about cost cutting. You really want to kind of similar as you have a worker on the shop floor who might experiment with, changing the process of how they build a car, or how they perform a very particular step in building this car and sharing their learnings from the shop floor as, is the Toyota production system. You want this for your knowledge workers, right? Just have them use AI, share what they're doing, get it implemented in some processes, and just kind of reap all these low-hanging fruit in your organization. I think that's a critical thing that I think more people should do, and they should kind of stop treating AI as a scary thing, because all the IT projects I've been involved in were scary and were risky and were awful.
I think that's a really, and it's a good point to end on because we've got a couple of minutes left. I think that as a thought that, I think there's almost a mindset change here. As you say, the IT projects, we've all been involved in them, are completely different to what we're talking about here. The only thing I would say, playing devil's advocate, is that, the point about moving out the way and letting people experiment, etc. In many companies, there's still, and I see it myself firsthand, strong command and control structures and cultures that just don't facilitate that. So they've got the tools, but they just have a command and control mentality that doesn't allow people to unlock them. Max, just because we've got 2 minutes left, just final thoughts from you, and then we will wrap up.
Just to add to your point, actually, I think this is where smaller companies have an edge, where they can experiment and try out new things, and the corporate structure isn't that rigid. And actually, that just reminded me of a recent study by MIT. I think they said like 95% of internal AI projects didn't deliver the promised benefits. But again, it doesn't mean like it's not useful. Again, we're still experimenting, and a lot depends on the corporate culture. But my personal approach is very practical. I do use it. Is it 100% reliable? No, sometimes it hallucinates. But is it useful enough? Yes, absolutely. And again, I still think we will discover more ways how to actually apply AIs across different domains.
Great. Well, that's great. Well, we're up on time. The hour has flown by as usual. We managed to pack in today Dostoevsky, if I can say that word correctly, AI capex, and also some terrific charts and data, Max, that you have provided. So thank you to the audience for listening and participating. As always, visit Marvin Labs, check out the analysis and the AI chat tools live in action, sign up for our newsletters, and follow these LinkedIn live events, which happen monthly. Next month, we'll be talking, as we said, about gaming and some of the infrastructure and AI changes in that space. So Max, Alex, thank you for participating today, and we will see all of you and the audience again. Thank you.
Thank you.
Thank you.